When most people think about retirement risks, they often think about market crashes or running out of money too soon. But there's one risk that's even more financially devastating and often completely overlooked within retirement plans, and that's the risk of needing long-term care. Whether it's memory loss, mobility decline, or chronic illness, one health event, especially later in life, can wipe out decades of hard work. And yet, most retirees don't have a plan for it. Today, we're going to break down the real cost of long-term care, how to think about insurance versus self-funding, and when a hybrid policy might make more sense than either one. And before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. So what is long-term care and who needs it? Long-term care isn't just nursing home care. It includes assistance with daily living, things like bathing, dressing, eating, toileting, or moving around your home. This care can take place in your own home, assisted living facilities, memory care centers, or nursing homes. And it's not just for the very old. A stroke at 70, a cognitive decline at 80, a bad fall at 75. These are the real-world triggers that create long-term care needs. The reality is that married couples aged 65 or older will need some form of long-term care for one of the spouses within their lifetimes. So how much does it actually cost? Here are the national averages for 2025. A home health aide would cost about $65,000 per year. An assisted living facility would cost around $64,000 per year. Skilled nursing or a private room would be $120,000 to $150,000 annually, and memory care somewhere around the ballpark of $100,000 per year. And those are just the average costs. In high cost of living areas, those numbers could be 25 to 50% higher. But here's the real kicker. Long-term care often lasts 3 to 5 years. In some cases, especially with Alzheimer's or dementia, it can last 7 to 10 years or more. So we're not talking about a $50,000 event. We're talking about a potential $300,000 to $800,000 risk per person. And Medicare, that's not going to cover most of it. So what does Medicare cover and what doesn't it cover? Many retirees mistakenly believe that Medicare will pick up the tab. But here's what it actually would cover for you. Short-term rehab or skilled nursing at hospitalization up to 100 days, home health services that are medically necessary, or hospice care. But long-term custodial care, the day in, day out help with dressing, bathing, and eating, that would not be covered by Medicare. That cost falls solely on you, either out of pocket, through private insurance, or eventually through Medicaid after you've spent down most of your assets. But you typically don't want to rely on Medicaid if you're looking for good care. Let's walk through a brief example. Let's say that a married couple, both 75, needs money to spend $80,000 a year, and all their money is in traditional retirement accounts. Outside of the fact that their planner did them absolutely no favors with Roth conversions or income planning, let's talk about the implications of a long-term care event on top of this. Let's say one of the spouses needs to move into a skilled nursing facility that costs $120,000 a year, and the other spouse still has the same $80,000 per year in living expenses. Let's also assume that their Social Security benefits are $40,000 between the two of them. They would need $160,000 annually after tax to cover all of their expenses. When you factor in taxes, they're going to have to withdraw $190,000 each year to cover their living expenses and taxes. If the spouse lives through 3 years of a long-term care event, that's $570,000 gone from the portfolio. If the market contracts during that time, it can also cause sequence of returns risk issues for the couple. But even if they started with a $1 million portfolio and earned a 6% rate of return, they would only be left with about $580,000 at the end of those 3 years. So a relatively short long-term care event wiped away nearly half of their portfolio over that 3-year period. This is why it's so important to consider how you're going to fund these events. Now, in this scenario, that's only one of the spouses incurring a long-term care event. Imagine how much worse the numbers would be if you had a longer duration or both spouses incurring an event. That's where we can see 7-figure portfolios vanish over a few short years. So now let's go over options to help you cover this type of event. Option 1 would be self-funding, and this refers to retirees who have enough wealth to self-insure. That means setting aside a portion of your portfolio to cover long-term care expenses if they pop up. This gives you flexibility. There's no premiums, no insurance underwriting, and no locked-in policies. But it also comes with risk. If you or your spouse both need care, those costs can compound. If the market declines while you're spending, your nest egg can erode quickly. And if you never need that care, you may have underutilized those assets for decades, which could have been much greater due to better growth prospects through a more aggressive investment strategy. Self-funding typically works best for those with portfolios well above their retirement income needs. The second option would be a traditional long-term care insurance policy. And traditional long-term care insurance is designed purely to reimburse you for eligible expenses due to a long-term care event. And here's how it works. You pay an annual premium for a specified number of years of the rest of your life, which could increase over time. If you qualify, meaning you can't perform 2 of the 6 activities of daily living, the policy pays a daily or monthly benefit. You get coverage for a certain number of years, typically 2 to 5. The pros of this: it's high potential payout relative to the premiums paid. It can protect your assets from being depleted. Premiums may be tax deductible, especially for business owners, but there are some cons you need to be aware of. Specifically, premiums are not guaranteed and may increase. If you never use the coverage, the premiums are lost, and your beneficiaries receive a severely discounted death benefit in some circumstances. And underwriting on these type of policies can be very strict, especially after the age of 65. And due to industry volatility, many long-term care insurers have exited the market or raised premiums sharply in recent years. So make sure you read the language in your contract to ensure how much your premium could increase in any given year and whether you can afford the worst-case scenario. The third option is a hybrid long-term care policy, and hybrid policies combine long-term care benefits with life insurance or annuities. And here's the idea. You pay a single premium or structured payments over time. If you need long-term care, the policy pays out a multiple of your premium or a percentage of your death benefit. And if you never need care, well, your heirs would then get that death benefit, typically tax-free in the event of a life insurance payout. It's use it or use it differently instead of a use it or lose it policy. And these policies are growing in popularity because you know your cost up front, there's flexibility with premiums, some come with a return of premium feature, and underwriting may be more lenient than traditional long-term care policies. But you need to be aware of certain things. The upfront costs can often be high, often $100,000 or more. Benefits may not be linked to inflation unless you add riders, and they're often more complex to compare than standalone long-term care policies. Another thing you want to be aware of is underperforming markets and variable insurance contracts with long-term care riders could necessitate larger contributions to offset that poor market performance. So how do you choose the right strategy? Start by asking, do I want to protect my assets, or am I comfortable self-insuring? Am I healthy enough to qualify for coverage now? Do I want flexibility or certainty? Is legacy important to me or just covering costs? And what does care cost in my state or city today, and how will that change with inflation? For some, self-funding with a large taxable account makes sense. For others, a hybrid policy creates the right mix of protection, flexibility, and legacy planning. And for those of you who want pure leverage at the lowest possible cost, a traditional long-term care policy may still be best if you get in early enough. But the biggest risk isn't choosing the wrong strategy, it's ignoring the problem altogether. Because when a long-term care need arises, whether it's you, your spouse, or your parents, the decisions fall fast. Who provides the care? How is it paid for? Do you sell assets? Do you burden your children? Without a plan, long-term care becomes a financial emergency and an emotional one at that. One health event can derail decades of careful retirement planning. Long-term care is one of the few risks in retirement that can't be diversified away, only planned for. That's why at NavWealth Partners, we help clients not just grow their wealth, but protect it, with real-world strategies tailored to your goals, health, and family legacy. If you're over 50 and haven't addressed this yet, now is the time to build a smart, tax-efficient plan for long-term care. Thanks so much for watching, and I'll see you in the next video.